Hello and welcome once again to Rethink Finance. This video is essentially a refresher of what we've already learned in a basic module on credit default swaps. From here on, we will be building on those basics. So this video is essentially a gateway to more advanced topics on credit derivatives. If you're already familiar with the basics of CDS, then this video is for you. If not, then I would urge you to first go through our basic module titled Credit Default Swaps Explained, which is available on YouTube. Even if you do have a general understanding of CDS, you will still gain important information on the subject, and that in turn will help you when we get to the more advanced topics such as trading strategies and valuation. Alright, with that introduction, let us now look at how to trade credit default swaps. We will start by doing a quick recap of what we've learned so far. We know what a credit default swap deals with. It deals with the credit risk of an underlying entity. In the world of CDS, this entity is known as the reference entity because the CDS references the credit risk of this entity. Now we know that this reference entity can be a company, a sovereign, or a municipality. Or in some cases, it can also be a collection or a basket of reference entities, which is when we're talking about multi-name CDS. Now, multi-name CDS is not the topic as of now, it's a topic for a later time. For now, we're going to be dealing with single-name CDS. Okay, so we know that a CDS deals with the credit risk of the reference entity, but what exactly is credit risk? It's the probability that the reference entity is going to default on its debt. And therefore, credit risk is commonly measured by a metric known as the probability of default. There are other ways also in which you can measure credit risk. For example, by analyzing the company's business outlook, its leverage, its cash flows, profitability, the quality of its management, the strength of its balance sheet, its financial policies, etc. But even then, your analysis will lead you to the answer to that same question. What are the chances that the reference entity is going to default? Or, put it differently, how far is the reference entity from a default? So, going forward, we will use these two terms, credit risk and default probability, interchangeably. Now, what is the relationship between default probability and CDS? If the chances of default increases, then the CDS gains in value, which is quite intuitive because CDS provides protection against default. Therefore, an increase in default probability means an increase in the CDS spread. And likewise, a decrease in the default probability means a decrease in CDS spread. Another way of looking at credit risk is it tells you how far a reference entity is from a default. And over time, as the credit risk increases or decreases, so does this distance to default. So when a company inches closer to a default, its CDS spread widens, and when it moves farther away from a default, its CDS spread narrows. Now the important thing to understand here is that just because a reference entity has moved closer to the default point, it does not mean that it'll actually default. Because reference entities can still find ways to avoid a default. It can sell some non-core assets, it can raise fresh equity from the market, it can arrange for some emergency funding, or it can sell itself to another company. Basically, it can raise additional resources to pay back its debt and ensure that it does not have to default. Plus, you need to understand that a default brings its own set of problems. It damages the reputation of the reference entity, it transfers the ownership, brings about a change in the management, creates labor unrest, political problems. You get the drift. There are many problems that can arise if a reference entity voluntarily chooses to default. While that does not mean that a default should be and always is avoided at all costs, but what it means is that it is a situation that's best avoided in most of the times. Right then, with that recap, let us look at how to trade credit default swaps. Let us take a hypothetical reference entity, call it company X. Let's assume that you expect the default probability to rise. And that could be because of several reasons. Maybe the company decided to increase its leverage. Maybe it decided to acquire another company, or that its business prospects are deteriorating, or its competitors are surging ahead. No matter what the reasons are, the bottom line is that you expect the creditworthiness of company X to deteriorate. In other words, you expect its default probability to rise. And if that happens, then protection against default will become more expensive. So its CDS spread should widen. As a CDS trader, what do you think you should do in this situation? Well, you can buy the CDS of company X today, and in future you can sell it at a higher spread and make a profit. Let's assume the CDS of company X is trading at 650 basis points today. And over the next 3 months, things indeed turn out as you expected. The default probability rises and the CDS ends up quoting at 700 basis points. So you're sitting on a 50 basis points gain on this trade. Now when you unwind your position, let's see how much you're going to be making on this trade. We know that CDS contracts today are standardized, and a CDS trade always involves an upfront payment. Let us assume the CDS of company X carried a standard coupon of 500 basis points. Since the cost of protection, which is the CDS spread, is 650 basis points, you, the buyer, will therefore have to pay an upfront fee to the seller. Now, this is something we've discussed in a basic module. So if you're not familiar with the concepts of upfront fee and standard CDS, please go through parts 3 and 4 of our basic module here. Alright, coming back to our topic, a CDS spread of 650 basis points will translate into roughly 5.5 points upfront, which means you have to pay 5.5% of the notional upfront if you want to buy the CDS today. And 3 months down the line, when you want to unwind your position at 700 basis points, you will be receiving an upfront fee. How much are you going to receive? For 700 basis points, that upfront fee works out to roughly 7.25 points. So you make a profit of 1.75 of a point on this trade, which for a notional of 10 million comes to 175,000. Another way of looking at it is, in 3 months, you've made a profit of 1.75%. So if you annualize it, that comes to 7% in a year. Not bad, isn't it? Well, you were able to make this profit because the default probability moved in the direction you expected it to move. But what if that did not turn out to be the case? What if default probability actually decreased after you bought the CDS? In that case, the CDS spread would have narrowed and you would be sitting on a loss, isn't it? So let's assume the default probability indeed went in the opposite direction. It fell after you bought the CDS. And therefore the CDS spread narrowed to 600 basis points in 3 months. So you're now sitting on a 50 basis points loss. Now if you want to unwind your position and book the loss, how much would you receive in upfront payment? For a spread of 600 basis points, that comes to around 3.75% of notional upfront. So your loss is 1.75% of notional for 3 months or 7% annualized. And that's pretty simple to understand because when you were making 50 basis points of profit on this trade, you were gaining 1.75%. Now when you're making 50 basis points loss, you're losing the same amount. Okay, so all of this was from the CDS buyer's perspective. Now let us imagine this trade from the perspective of a CDS seller. What does it tell you? If you, the buyer, made a 1.75% loss on this trade, then the seller should make same amount in profit, isn't it? Well, that is true only on one condition, and that is when the seller decides to unwind the position with you, the buyer, when you decide to unwind the position with the seller. So let's say 3 months down the line, you're suffering a 50 basis points loss and you're not liking it, so you go back to your seller and tell her, you've sold me the CDS 3 months back, but I don't want to bear this loss anymore. So you buy it back from me now. If the seller obliges, then yes, she makes 1.75% profit on this trade and you make 1.75% loss. But if you put yourself in the shoes of the seller, you'll realize that she may not want to unwind the position when you want to. Because when you look at it from the seller's point of view, she's called it right, hasn't she? She expected the default probability to fall and it did fall, and she is making profits on this trade. So she may well want to make more profits instead of unwinding her position with you immediately. Therefore, she might want to hold on to her position, and while she's holding on to the position, she might want to keep collecting the 500 basis points in premium. So the seller does not want to unwind the position with you, not so soon. Where does that leave you, the buyer? Does it mean that you're stuck with your loss? No, because there is a market for CDS out there. If your original seller does not want to buy it back from you, you can find someone else in the market who might be thinking that, well, yeah, default probability has fallen, but I expect it to rise because of, these reasons. So that guy might well be looking to buy the CDS at the same time as you're looking to sell. So you can do a trade with that guy and unwind your position. What exactly are the mechanics of this unwind is something we're going to be looking in the next episode. But for now, it's important to understand that there is a market out there and you can always unwind your position if you don't want to bear any more losses, or if you're making profits, you want to book your profits. Okay, so that's good news. Now let us turn to the left side of the screen and look at our first case once again, where you called it right and were making a profit. But this time, let's look at it from the perspective of the seller, because since you're sitting on a 50 basis points profit 3 months from entering into the trade, the seller is sitting on a 50 basis points loss. What do you think the seller should now do in this case? Should the seller just unwind her position, buy back the CDS and book the loss? Well, she can, but if she doesn't wanna, it's definitely not the end of the road for her. Remember, the seller originally had a different perspective from the buyer. And that is true in any market, not just CDS. Maybe the seller feels the rise in default probability is a temporary thing. Over the longer term, default probability is going to fall, and it's going to fall to even lower levels from where it was when she entered into the trade. That's her perspective. That could be. We never know. Maybe she feels that the business outlook is going to improve in the longer term, or the management will improve the balance sheet because it wants a higher credit rating. Whatever the reasons, she has a different perspective on company X's credit risk than you, the buyer. And that is why she was selling the CDS when the buyer was buying. And let's say 2 years down the line, things do work out as the seller was hoping. The default probability indeed slides down. So the CDS she sold for 600 basis points, 2 years down the line is quoting at 400 basis points. So the seller is making 250 basis points on this trade. Now what's her payoff? When she sold the CDS at 650, she received 5.5 points up front, something we saw earlier. Plus, over these 2 years, she received premiums. So that's 2 times 500 basis points, which is equal to 1,000 basis points or 10%. Now when she buys back the CDS, how much is she going to be paying up front? Well, the truth is, she's not going to be paying anything up front. Instead, she is going to be receiving an upfront payment. Well, that is because the spread at which the CDS is quoting now 2 years later is 400 basis points, while the standard premium is 500 basis points. Again, if you don't understand why this is so, please refer to our basic module. So coming back to our example, 400 basis points in spread works out to roughly 4 points up front. So that's 4% of notional that the seller is going to receive, not pay. So how much does the seller make? She made 5.5% of notional when she sold the CDS to you, plus she made 1,000 basis points in premium, and now finally when she's unwinding her position, she's making another 4% of notional. So that comes to 19.5% in total in the space of 2 years. That's almost 10% in a year. Now this return was possible because things worked out as the seller expected. But what if things did not work out as per her plans? What if company X's default probability did not fall? Instead, it kept rising. What do you think would have happened? She would be sitting on a loss, isn't it? Instead of sitting on a profit. But remember what we said at the start. Even if default probability keeps increasing, it does not mean that company X will actually end up defaulting, because there are ways in which it can prevent a default, as we've just discussed. And the seller knows that. That's why she took the risk of selling the CDS. So the seller is most likely making mark-to-market losses, but she hasn't booked her loss. She doesn't need to, because she can keep holding a position and earn 5% in premium every year, and more likely than not, company X will not default, and so she will not have to pay up. Or she may have realized long back that she's made a mistake, and so she may have hedged her position by buying a fresh CDS on company X. And if she's done that, she has a short CDS position as well as a long CDS position. So her economic interest is hedged, which basically means she's default neutral. If company X actually ends up defaulting, it doesn't matter to her anymore. So hopefully that gives you an idea of how to trade credit default swaps, how you can make money or at the same time lose money trading CDS. But whether you're making profits or losses trading CDS, the question is, how do you book this profit or loss? What are the mechanics of unwinding a CDS trade? And that's something we're going to look at in the next episode. So if you're interested, we'll see you then.